What up, guys? It's August 23rd, and it's time to get serious about these markets because the bears are back and volatility is stricken again. And for the greater part of 30, 45 days, everything was really good until these guys got back on us and steamrolled us and gave us a shellacking in these last couple of trading days. So we're going to go over everything that's going on, everything that happened last week when it comes to retail earnings, some technical analysis stuff. But before we do, please hit that like button, hit subscribe. Hopefully you learned something from these videos, and we have some fun in the meantime, okay? Let's get to it. So here we go. We got the action for today, Tuesday, August 23rd. We got the Dow Jones down about 0.5%, no big deal. S&P down about 0.25%. NASDAQ flat on the day. I think that's a win because that's a tech outperformance on the other two indices, and then the Russell outperforming all of them to the upside, okay? We do have the VIX over 24. Pretty important to keep an eye on that because, of course, when we see the VIX elevated over 25, closer to 30, that's a huge buying indicator in my book, okay? When we see these really big spikes on the VIX towards 30 or over 30, tells me that the market is probably panicking too much and is likely oversold. Of course, that's not the only indicator we look at, but that's a big thing to watch here is the VIX volatility index, okay? We also have bond rates going over 3 on the 10-year bond yield. Got energy. We got WTI over 90. Not good. We don't want that. Remember, energy stocks and tech stocks are two completely different things. They're two opposite ends of the spectrum right now. So when we see these energy prices go higher, it means that it takes the energy stocks higher and tech stocks lower. So that's not good for us. And then natural gas, of course, doing the same thing, outperforming on the day, 9.28 for natural gas. So not good on those numbers at all. And then to move on here, we still got earnings season. We're winding down earnings season. That's a good thing, okay? I get really busy, and we talk about a lot of things during earnings season, a lot to watch, especially this time around. We're watching for guidance. Remember, guidance is the big thing for earnings season. We got Jackson Hole going on with the Federal Reserve on Friday. Jackson Hole they're called Jackson Hole because it's a city in Wyoming. It's called Jackson Hole, Wyoming, and it's kind of like the Fedopalooza. It's their main meeting of the year, their biggest meeting where everybody gets together, and you have plenty of interviews, but most importantly, Jerome Powell, the chair of the Federal Reserve, giving his usual speech on interest rates, the fight against inflation, monetary policy, etc. Very important for shareholders. So watch that on Friday. And then, of course, market volatility, the return on market volatility. We're going to go over some technical indicators, some charts, and let you know kind of what I think and what we see moving forward. Okay, now, I want to recap some earnings from last week, which I think were pretty important. These were the retail earnings from these big giants, right? We got Walmart and Target reporting earnings last week, and they said some pretty important things. We watch these guys because this is the pulse of the economy, the pulse of the consumer, which is one of the things that as a bullish investor we have to cling to is a strong consumer. But as that starts to wane, right, we have to know that the equation in the stock market is going to change, and people are going to get less bullish if the consumer starts experiencing weakness. The way that I see it, the low-end consumer is the most vulnerable. Then you have the moderate to high-end consumer, still practically strong, okay? We talked about videos ago, Bank of America, credit cards, all these companies, financial companies, saying exactly the same thing I'm telling you right now. Medium to high-end strong, low-end feeling the brunt of it, okay? Now, when we talk about Walmart, okay, they previously had cut their quarterly and full-year revenue guide. We knew that coming into the quarter, so not much of a surprise for them to get bad numbers there, okay? They did beat the estimates, okay? But they gave us a warning that the consumer was focused on lower prices, even the high-end consumer. So that's something that is negative for us bullish investors that are counting on the strength of the consumer. Not a good thing to hear here, okay? And then 8% still year-over-year sales growth, which is kind of surprising that they have sales growth, but they're telling us here that the customers are focusing more on lower-end, lower-margin products, okay? So lower-end, lower-margin products, which affects the EPS, the profitability measurement of the business, okay? CEO Doc McMillan said, people are really price-focused right now, regardless of income level. That's something we don't want to hear, okay? But they did see an increase of customers with annual incomes of $100K or more. That's pretty interesting. It means people are adapting and people are choosing to go get better deals at a store like Walmart, okay? And then here we have some common trends. That's why I put them in different colors here. Some common trends around all of the retailers that are reporting. Okay, so they're canceling future orders due to oversupply and reducing prices, giving a lot of promotional activity. So we already knew this from a long ago. Target's doing this, Walmart's doing this. Home Depot is not doing these. Home Depot is actually passing along the price of inflation to the consumer shamelessly, and Lowe's doing it, but to a lesser extent, okay? And it has a different little dynamic here between Home Depot and Lowe's that we'll talk about as well, okay? But when we're talking about essentially Walmart and Target, we're talking about two major retailers that made a major mistake once 2021 was over. They got heavy on inventory, particularly clothing, also known as apparel, and electronics. The wrong kind of inventory for the wrong kind of consumer. As you can see here, the consumer are more focused on lower margin products. And what do you think about when they're talking about lower margin products? We're thinking about groceries, right? We're thinking about little things in the aisles like the little gifts and little plants and little things here and there that don't have these big markups like electronics and apparel in a lot of instances. So they got the wrong product at the wrong time, and they got way too much of it. So that's why they have to cut prices, which is deflationary by nature, of course, okay? Now, spending less on electronics and more on groceries, just like we talked about. For Target, okay, when we're talking about Target, a little bit of a different animal, a little bit of a different consumer. This is more like the low-end to moderate consumer, and this is a moderate to higher-end consumer. Target previously gave us two separate warnings, one in May, one in June, in which they were preparing investors that the quarter results would not meet the expectation, okay? This is not surprising at all for the same reasons we just talked about. Apparel and electronics, which Target is huge on, okay? They didn't meet the revenue expectations, but hard miss on EPS, exactly for the same reasons. People are spending more on groceries than electronics, which are higher margin items, okay? Now, they're reporting that customers feel the burn of inflation. They're taking advantage of promotions. They're shopping more, but in less frequent trips. But shoppers still show spending power, but confidence is in a downturn. Okay, so this is what we don't want to hear, but I think it's sort of tame the way they're putting it. So it's not all bad. It's not all good. It's somewhere in between, trending to good, actually, closer to good. But of course, they're saying it's in a downturn. It remains to be seen how much of a downturn it's in, okay? They're canceling future orders due to oversupply and reducing prices. Same thing here as Walmart, of course. 90% hit to EPS from a year ago. So remember, EPS, earnings per share, measure profitability. They're down 90% on their profitability. Incredible. That's a disaster, okay? And then that results in price markdowns on excess inventory impacting their profit margin. This is what they were warning us, guys. This is the reason the stock sold off big time, okay? Now, moving on to Home Depot and Lowe's. We got Home Depot's quarter was better than Lowe's, and Home Depot delivered, and pardon the typo there, they delivered their highest quarterly sales earnings in their company's history. And oh my God, like how confusing can the U.S. consumer get? I mean, you're talking about something entirely different with Target and Walmart, but Home Depot is saying, nope, highest quarterly sales and earnings in the company history. Unreal. But it all goes to we're not passing the price of inflation to us. We're passing it to the consumer. So probably that has a lot to do with it, but it also confuses us investors because we're seeing some weakness, a lot of weakness here, and not a lot of weakness here, okay? Now, they reported that customers still spending more on home renovations, even with a weak housing market. Confusing, okay? Doesn't jive with here and here, okay? And then customers are not trading down to less expensive items despite inflation. Confusing again. And then there's growth in both professional and DIY projects. Confusing. And then Lowe's here is reporting that their quarters were mixed because they're more focused on the DIY consumer, the do-it-yourself consumer rather than professional consumer. That's a different dynamic between Lowe's and Home Depot. Okay, Home Depot is more professional type consumer. Lowe's is a do-it-yourself consumer. Okay, that's you and me. So they're saying that consumers were trading up. Trading up on merchandising, favoring more innovative products. How do you jive these two things, right? Like, what are people prioritizing? So this just confuses regular investors like us, in which we're trying to get the pulse of the consumer, and you got retailers saying essentially completely different things. Hard to follow. Okay, now enough of this. Let's move on to this week with the earnings. Okay, and we're already on Tuesday, so we already know a couple of companies that reported here that we've been paying attention. Zoom and Palo Alto yesterday in the afternoon. So for Zoom, it's just a complete disaster. Okay, just this stock is still extremely expensive. This is one of these Kathy Wood names. I think it's like her second biggest holding in her portfolio for ARK Invest, and I think ARK Invest really needs another pandemic in order to make money, and it's sad to say, but I just don't know what their train of thought is in buying more Zoom. I look at their buys and sells every day on social media when they post these things because they make them public. Makes no sense to me what they're doing here, but I guess they got a really long-term strategy, so we'll see how that plays out. Okay, I think anybody who wanted Zoom in the world probably already has it. So I'm not sure. They did say that they will experience 10% CAGR. That's a compounded annual growth rate from here to like 2025, if I remember correctly. Okay, I guess, but it's still extremely high price for this stock. Okay, and then we have a completely different situation with Palo Alto cybersecurity. Cybersecurity has growth as far as the eye can see, and you're paying a excellent, rich valuation for Palo Alto if you're buying it. Let me show you an example. Here real quick, we look at the Palo Alto Network's valuation. We see a forward PE, my favorite measurement, 55. I mean, extremely rich. I don't even want to look at the stock if it's over 50 as far as a forward PE ratio. It's too pricey, too rich for my taste. I honestly rather chop a hand off than buy a stock that's over a 50 forward PE. All right, now that's Palo Alto. Nothing else here that we need to talk about for this day for Monday. Now on Tuesday, Nordstrom. That's one that is an apparel stock, and they reduce guidance. Again, remember, guidance is the most important thing that investors are watching this earnings season, and they reduce guidance. They're over inventory. No surprise there as far as Nordstrom not doing well with tons of apparel that they have. Okay, now Toll Brothers is one that's very interesting. Okay, let me show you guys the measurements here on Toll Brothers as far as the valuation. Now, for those that don't know, just to be quick, Toll Brothers is a high-end home builder, and it's been pretty demolished in the last couple of months here. We see here, let's put up a 6-month chart. Pretty bearish action. I mean, it doesn't look terrible, but if you put a year-to-date chart, you see here 65 to 45. That's about what, a 30% decline, almost 40%, maybe 35% decline. But if you just remember the measurement, the forward PE on a stock like Palo Alto, look at the forward PE on Toll Brothers. Completely the opposite story. Forward PE of 4. I mean, PE ratio of 4. I think you would have a hard time finding stocks that are valued this low. So I think that Toll Brothers it's a stock that I would really like to own because it's a phenomenal business. I think this could be $100 stock easily, probably when the housing market recovers. Right now, remember, the Federal Reserve is targeting housing, so Toll Brothers is going to feel the burn of the Federal Reserve for a bit, but this is the high-end consumer, and I think the high-end consumer is going to be just fine, no matter if we have a recession or two in front of us. I think it'll be just fine, and they'll be building some more homes for Toll Brothers later. So I think this is a good long-term bet, even at this price. I'd like to get Toll Brothers under 35, to be honest, so probably another 10 points would be nice to get it, to have a really good entry point on Toll Brothers and collect some dividends, since it pays a nice 1.63% dividend. So not a bad stock there. Now that was today, right? Nordstrom and Toll Brothers. Next, for the following week, we're watching NVIDIA and Salesforce. NVIDIA, of course, is a semiconductor. It's one of the leader semiconductor stocks for graphics cards, CPUs, data center, gaming. Gaming is very weak, so the stock has been hit pretty badly, but it still trades at a forward ratio of about 40, so it's still pretty pricey stock. It may see a revaluation. Remember, these guys already pre-reported numbers, so there shouldn't be a big surprise on what the numbers are at earnings, but maybe the conference call is different because the Omniverse is what you're watching here. The Omniverse and sort of like the metaverse of business. I think this is a really interesting stock, and I think that if you own it under 160, you're golden here, and maybe to build a position just very patiently over time. Hopefully for you, it goes lower and you can buy some more. We got Salesforce. This is the big here cloud sales company, and it's just a monster. I think that these companies are probably not going to do well in a high inflationary, high rate environment, so probably not going to do well. And Snowflake is another one that I like to watch because it's kind of like the closest competition to Palantir. It's the closest animal, right? It's like there's apples and there's oranges and there's pears, right? Palantir's an orange and Snowflake's a pear. They're still fruits, but there's still sort of difference. But it's the closest comparison to Palantir. So definitely watching that tomorrow. Nothing else that really interests me here. And then of course we got Peloton, which is kind of funny. That's a disaster of a stock. I mean, that you could listen to that conference call and just laugh all day long on how wrong they got it over the last year or so. Nothing else here that interests me here for Thursday. And then we got Marvell Technology. This is the last company that reports for our portfolio this earnings season. So after Marvell Technology, I am done because I am spent on this earnings season. This is a semiconductor name, of course, for 5G enterprise. They're only exposed to the consumer. About 10% of their business is a consumer for cell phones, but Marvell Technology for business 5G is an incredible stock, okay? If there's any weakness there, I don't mind adding to the stock at all on weakness. And then after that, Ulta. I think Ulta is always interesting to me. It's a great business. Definitely one that's fun to watch and usually performs really well even in bad times. So moving on, we're going to talk about the Federal Reserve a little bit. I want to kind of give you this little diagram, if you want to call it here, to show you essentially what the Fed is dealing with, what they're trying to balance in the act of fighting inflation. Because this Friday, we're going to get the latest and the most accurate detail as to what they're thinking and how they're moving forward. Are they going to take a more dovish path, an extreme dovish path, a moderate sort of in-between hawkish to dovish stance, or an extreme hawkish stance? Okay, of course, the hawkish, of course, is higher rates, more quantitative tightening, trying to take liquidity out of the economy, while dovish is lower rates, making lending easier, access to cash is very easy monetary policy. Okay, so this is when markets go higher, but of course when the Fed is too dovish, that's when you sacrifice higher inflation. And when you're too hawkish, you sacrifice the economy in favor of lower inflation. So this is everything they're dealing with here, guys. The price of cars. So we know that the price of cars has been going down, which is good. This makes the Federal Reserve go this way, right? So energy prices makes the Federal Reserve go that way because they're going higher and they're stubbornly high. There's rising inventory levels for retailers. That makes them go dovish because retailers reduce prices in reaction to higher inventory. More promotion activity means lower prices, means the Federal Reserve can get more dovish. Rental housing costs. The most problematic part of inflation is rental housing costs. That causes the Federal Reserve to go hawkish, okay? And then extremely strong employment data. So we know the employment landscape is very strong. There's way more jobs than people to work them in the U.S., okay? If you don't believe me, just look at the data. It's not a political thing. Just look at the data. That makes the Federal Reserve go more hawkish. The Federal Reserve wants to see layoffs in order to turn more dovish. The market wants to see weak employment data. It's kind of weird to say, but the bad news is good news for the market. That's kind of the world that we're in the reverse, okay? We have housing market collapse, okay? The housing market is collapsing slowly, but it is collapsing. It'll take months for housing prices to really trickle into the economy. I'm talking about lower housing prices, but that makes the Federal Reserve be more dovish. And then crash of commodities. Commodities have crashed. We're talking about metals, chips. We're talking about the price of grains, the price of lumber. These commodities have crashed, makes the Federal Reserve more dovish. And then companies lowering guidance, that helps the Federal Reserve say, hey, we're doing our job. We can get more dovish. And then, but share buybacks and dividends say, nope, you got to get more hawkish because they're still buying back stock at record levels and paying record dividends. I'm talking about energy stocks in particular. So this makes the Federal Reserve get very hawkish. And then the price of food, hawkish as well, because it is stubbornly high still. So if you guys can see here, all that I'm blabbling about here, the Federal Reserve has a lot to contend with, a lot of cross data information. I mean, if the Federal Reserve is looking at things like this, right, when we're talking about, well, let me see here. Okay, look at here. When we're talking about Walmart, Target, Lowe's, and Home Depot, this is all cross data that really doesn't jive. It doesn't jive. These guys are not jiving right now. How is the Federal Reserve supposed to look at this great data from Home Depot and compare it to the bad data from Target and Walmart? What is the consumer doing? That's very confusing, and I bet it is still very confusing for the Federal Reserve. Okay, now the last thing I want to go over are some market technicals. Okay, because the markets have been going down in the last couple of days, and we watch them go down, but we're still not making any major moves. I think I made a small move on Palantir, a very, very small move, but that was it, okay? I'm waiting for some major action, and essentially what we should be doing while the markets are roaring higher like they were in the last 45 days, we should have been building cash in our accounts, ready to deploy when these moving averages are hit. So here we have a chart, a year-to-date chart of the NASDAQ, and we see here some simple moving averages, okay? So we have the gold over here, which is the 90-day moving, the 200-day moving average. Let me make sure that that's correct. Yep, 200-day moving average, okay? And then we have the 90-day moving average in the green right here, 200 right here. So when we see this channel, we see that the NASDAQ entered this channel right here about August, and it got overbought. It pretty much almost hit that 200-day wall, and it went right back down to hit that 90-day wall. So as far as I'm concerned, as an investor, I am not going to buy this market until the market crosses under the 90-day moving average, because we've got a lot of room here. And when the market goes down, you can expect also this 200-day moving average to continue to go lower as the market moves down. But if it steadies on, maybe it'll steady and it can rally later into 2023. Okay, so we don't know what's going to happen, of course. Technicals don't tell us what's going to happen, but they give us good ideas of what to do as far as entry points. The last technical indicator that I want to give you that's very easy to get to is the CNN Fear and Greed Index. Okay, I really like looking at the CNN Fear and Greed Index because it gives you some pretty good data. Not only the meter here, which it says neutral, but other things like the market momentum. We have breadth. We have put and call options. I really like the put and call options indicator to see if it's a good time to buy, good time to sell, whether the windows are open or not, okay? Market volatility with the VIX, we see that here. Safe haven demand, junk bond demand, and other things. But essentially, I would suggest that if you're new, you look at the pull to call option ratio, and you're looking for the lowest number as far as, not the lowest number, the highest number for fear. So the higher it is, the more window of opportunity you have to add to stocks, okay? So every time that it's hitting these kind of averages here, it would be a good time for you to consider adding. Not that you should add every single time, but you should consider adding and consider like, maybe I'm getting a window of opportunity here to add if a market becomes oversold. And then when it comes to the actual gauge here, we're buying markets that are right here in the extreme fear side. We're not buying anything over extreme fear in this environment with the Federal Reserve on a hawkish stance, raising rates, and essentially clawing us off with quantitative tightening and rate hikes, okay? We expect those to taper off because inflation, we do think, has peaked, but at the same time, there are some stubborn areas of inflation that may cause these guys to not be done and to do more than the market expects. We'll find that all on Friday and get a good idea of what they're thinking. So tune in on Friday for the Federal Reserve if you're an investor. If you guys have any questions as to what we talked about, please let me know, okay? Please hit me up on Discord, Instagram, and Twitter. I'd be happy to help any of you guys, okay? Peace out.